Good morning, good afternoon, good evening. Welcome to this pre-FFD business webinar on innovative private sector partnerships, investing in development collaboration. My name is Norine Kennedy, and I am Executive Director of USCIB's Foundation and Senior Vice President, Global Strategy and UN Affairs for USCIB. We have some very light housekeeping rules. They're as easy as can be, and maybe there's a third one that I'll mention as well. The first is, as you can see at the upper left-hand corner, the session is being recorded. We really and truly encourage you to be involved in the conversation. So do post questions or comments in the Q&A and chat so that we can get you involved. We have some really exciting speakers, and we want to be as efficient as possible to use the short time we have, but do weigh in. And I think the last one is just if you have not been given the floor, please stay on mute so that we don't have extra noise. So let's go to the next slide, please, Jen. I want to just say a few words about the USCIB Foundation. It is dedicated to really research and education as part of the United States Council for International Business. It promotes the benefits of a free market economy and demonstrates and documents the role of business in economic growth and social development. We've done many diverse things over the year, and I've come into the leadership of this foundation just at the beginning of this year. So it's a very exciting moment. And Jen has put into the chat a link to our webpage so you can learn more. But I think one observation I'll make is that we do have the DNA of the U.S. Council for International Business, even if we're a separate part of USCIB. And in that respect, we approach global challenges with a private sector problem-solving approach, always reflecting on the necessity of business to work with governments, intergovernmental organizations, and other stakeholders to address the challenges of our times. And it was with that intention that the USCIB Foundation joined with USCIB's Moving the Needle initiative to launch the Business Pact for the Future last year as a contribution to the UN Summit of the Future. And again, Jen is putting in the chat a link to more information about the BPF, or Business Pact for the Future. BPF shines a light on what it takes and what it will take to fully engage business in ramping up action through and with the UN towards the 2030 agenda. It seeks to answer the question, which I think everyone has in front of them that is working in the UN these days, in terms of how we mobilize business tools, know-how, information, and partnerships in a focused way and in the areas that will yield and catalyze the most impact while strengthening the UN, this vital institution, to those of us in the business community. So over the last couple of years, through a series of roundtables and discussions with many in New York and Washington, we tried to zero in on 4 such interconnected areas, which we consider to be force multipliers. And you can see those 4 pathways for impact showing now in the slide. They are interconnected, and according to our Business Pact for the Future, engaging business in partnerships across all of these 4 areas in collaboration with the UN system will be a force multiplier across a wide range of SDGs. So this year, 2025, and with the 4th International Conference for Finance for Development, FFD4, ahead, we turned our attention to mobilizing private sector investment in people-centered infrastructure, one of those pillars. From the Bridgetown Initiative to LDC5, from COP29 to a host of other arenas in which we are confronting the gap of necessary funding and resources against the pledges that have been made, it seemed to us that beginning a discussion of the potential for business engagement and what will make it possible was quite timely. As we have listened and participated in the deliberations leading up to F-54 and having reviewed possible outcomes and decisions from F-54, we definitely notice the increased attention to business and the private sector as a development partner. That is all to the good. It is gratifying to be recognized, yet we also see a missed opportunity to go further, to target the real potential of foreign direct investment and domestic resource investment in people and for people through relevant infrastructure, whether in education, skills training, or health and well-being. So in the brief time we have today, we wanted to make a start and face the changing landscape of international development collaboration and what it means for business. This begins a discussion that we will carry to Geneva next month in a roundtable of how new pathways for private sector investment with an emphasis on infrastructure can and will ramp up action on many fronts. In the first half of our conversation today, we have invited eminent experts from UNCTAD, the Harvard Kennedy School, and the OECD to share some of their analysis of private sector investment, not only what incents it, but also how it can be directed to infrastructure that benefits people, communities, workers, and society. To get us started, the president of the Economic and Social Council, and here are our eminent experts, Dr. Amelia Santos-Paulino of UNCTAD, Dr. Akash of the Harvard Kennedy School, and Dr. Mamiko Yokoi-Arai of the OECD, and I'll introduce them more properly when I call on them. But the president of the Economic and Social Council and Canada's permanent representative to the United Nations has shared a video message with us. Because as I think you know, in addition to his lead role at PECOSOC, he also works closely with the countries that are facilitating the preparations for the Finance for Development conference in Seville in late June, early July. So we posed a question to him and invited his perspective in a video message. And the question that we have asked him to comment on is to invite his view on the top 3 things he would like to see from business in the run-up to F-54 with respect to development collaboration. So I think we're going to run the video now, and we'll hear from Ambassador Rae. Jen, we don't hear the sound. Okay, we're going to just try to rectify this technical glitch and try running the video again. We did it in practice and it worked very well, but for some reason, we're not getting the sound now in this run. So just give us one more second. I think you can see that we are working on this.
On the I've been asked to comment on the top 3 things that we would like to see from business as we move forward on the preparation for the Financing for Development Conference. I'd like to really talk through with you a couple of things that I think business needs to do and can do and must do in order to help us move forward on financing for development, on moving forward on the Sustainable Development Goals, which are all critical for all of us. The first thing I want to emphasize is the need for business to continue to invest in people, invest in healthcare and education and skills development. Because these are all areas where companies can build resilient communities and a skilled workforce, both of which are really essential for sustainable economic growth. So we need the partnerships that will allow these things to happen. The fact of the matter is most of the economy is all tied up with business. It's not run by governments, it's run by companies and by workers who are working together. The second thing is we really need to make you feel that what you're doing is an example for everyone else. That sustainability is not something that other people do. Sustainability is something that businesses do. And that obviously is important. The example that you set is critical. And finally, growth has to be inclusive. This is not about being politically correct. This is about understanding that treating people fairly and equally and making sure that there's diversity and that there's real participation by everyone in the new economy is absolutely essential. We leave people out of the picture. We leave people on the margins at our peril. So we must seize this opportunity to build innovative partnerships that can drive change that is going to really have an impact. So those are my 3 priorities. I hope you can get on board. Thank you so much.
Well, I think it's safe to say that the USCIB Foundation and the Business Pact for the Future is most definitely on board. And I think a key message for our Business Pact for the Future has been that sustainability is indeed something that not just other people do, but the business community is deeply involved in and continues to be deeply involved in. So let's turn now to the first part of our program and move to our 2 eminent experts who will be talking to us about infrastructure investment and how to catalyze SDG action in a changing development cooperation landscape. I want to introduce our 2 speakers, Dr. Amelia Santos-Paulino, who is Chief of the Investment Research Section at UNCTAD's Division on Investment and Enterprise, where she leads research and policy work on international investment and development issues. And I was speaking with Amelia before we got started about how vital UNCTAD's work has been in the SDG space and how much we have appreciated partnership with the New York team. Our second speaker will be Dr. Akash, who is a senior lecturer in public policy at the Harvard Kennedy School. He specializes in finance, and he is the faculty chair of the Infrastructure in a Market Economy Executive Program. He's also served as a faculty chair of the Indian Administrative Service Executive Program at Harvard University and the Indian Institute of Management in Ahmedabad. So I have a prompt to both our expert presenters. I've asked each of them to share their findings on the multiple changes and uncertainties in the development cooperation landscape and where business investment in infrastructure is most urgently needed or can achieve the greatest impact. So each of our speakers has 5 minutes, and I want to directly pass the floor to Dr. Santos-Paulino, and thank you again for making the time and for the great insight that UNCTAD brings to this discussion. Over to you, please.
Many thanks, Norine. Thank you, everybody, for joining us, and to the Foundation for having UNCTAD joining the conversation. I will not take much time as a way of introduction, but I just wanted to say that your introduction, your prompt really resonates to what we do. We try to assess the role of private investment, foreign investment as a complement to other development finance flows. And what I'm going to do in the next 5 minutes is to give you a bit of a flavor of where we are and what are the challenges for private investment in the sustainable development scape. If you allow me, I'm going to share my screen briefly so we can start the conversation. Can you see my screen correctly? Yes, perfect. Okay, so basically, as I said, what I'm going to do is I'm going to focus a little bit on private investment, international private investment, and how it can contribute to close the development gap, to the investment gap to meet the sustainable development goals. So just to get started, let me show you the different type of investment flows that we analyze, which are closely connected to the business environment that the Foundation works with, and also the sustainable development landscape. So first of all, we have foreign direct investment. That's the flows that we measure through balance of payments data that we collect from countries. So we see a decline of 8%. We also see a decline in announced greenfield investment projects. Those are the projects critical for productive capacity development. And then we see a marked decline in international project finance, which is the mechanism, the vehicle which through which the private sector invests in big infrastructure projects. Norine mentioned infrastructure projects as one of the key issues here. And we see a light increase in cross-border mergers and acquisitions, but these are mostly financial flows between developed countries, so that they don't have a big effect on development. So basically, we know that development cooperation is undergoing significant shifts, and this landscape is mostly affected by uncertainty, the uncertainty that we are living because of shifting political and policy priorities, also how investors are reacting to this uncertainty and how the market is also reacting. So all these affect the investment landscape. Just quickly to put it in the context of development cooperation, here we can see how the foreign direct investment relates to other flows, for example, official development assistance and remittances. And we see that for developing economies, it represents the major and financial flows. Here we cannot see the trends, but also we show in our report that is not only the most significant, but also most stable flows of resources. Hence the importance of bringing private investment to the conversation. For least developed countries, the countries that form the UN classification on the right bar, we see that ODA is still important and is the most important, which is goes with the level of development of those countries. But this is to confirm the importance of foreign direct investment. Also, in terms of international project finance, as I mentioned, we have here we analyze how, the trends. I apologize, here in my screen is not showing the legend, but what we wanted to show here is the first group of countries. The first two columns is Africa, the second developing Asia, and the last two columns is Latin America and the Caribbean. And we have seen that most of the increase in terms of international project finance is the blue, the light blue, and this is renewable energy. So most of the financing when it comes to SDG sectors has been driven by the boom, the sustainability boom of the renewable energy transformation. We see a decline in other areas, but in general is Asia receiving most of the projects in comparison to Africa, and mostly in renewable energy and infrastructure, which is the two bars. We see a minimum going into key sectors, what we call social sectors like health and education, and a decline in agri-food system, which especially in Africa, which raises concerns about food security. And again, these are private investment flows in the form of international project finance. Just to summarize here, what we call investment in SDG sectors, those of us who work with data know that it's very difficult to match the 17 goals with investment data, but what we try to do is to group by sectors, as I said. So infrastructure, renewable energy, water, sanitation, agri-food system, and health and education. And we have seen, again, a deterioration in some goals like water and sanitation and agri-food system, but a boom in renewable energy. This is comparing last year with 2015 when the SDGs were launched. So yes, there is a bright spot when it comes to some sectors, but in terms of policy, a key concern is food security and the health sector and the challenges that it comes with it. Just moving on, another area where we have done some original analysis is to see, okay, we know the private sector is important. We know that this complements, and the idea is not that it displays official flows, but it complements official flows. One analysis that we do and a contribution that we brought to the COP, to the conferences of the Pact, was how partnerships can help to lower the cost of capital in developing countries, especially vulnerable countries. We know that capital is not free, that even private investment comes with a cost, that it depends on the level of development, on governance, on infrastructure existing in the countries. So just to summarize, because I don't have much time, we look at different level of engagements. For example, if the private sector, domestic private sector is involved, if the government has a stake, if multilateral banks come to these partnerships, we try to sort of define a modern public-private partnership for sustainable development. And to make the long story short, if we have what is called a full participation of public, private, and multilateral banks. And here also we include the Belt and Road related infrastructure projects, which are very important for African countries. We see that the cost of capital measured as the spread of debt can come down by 40%. So one issue that we have heard in the autumn meetings of the IMF and the World Bank and now in the spring meetings is the role of partnerships. And here we show it with numbers. It can go down from 8% to 40%. So we can not only bring to the discussion private sector alone, but also the role of partnerships. My time is over, but I'm happy to come back to some of these figures and issues and some of the messages that we are planning to bring to Seville, to Financing for Development, is that what can we do? And here just 3 areas where we can work is trying to fill critical gaps that I have mentioned in terms of SDG investment. Indirect through policies, for example, through tax revenues and to improving fiscal space. And in terms of qualitative is how we can help countries to develop their skill, to negotiate, to have what we call a bankable projects pipeline for sustainable development. I know, Norine, that my time is over, but I would like to stop and give the space to the next speaker, but I'm happy to come back to some of these issues.
Thank you so much for this very clear presentation, and I think, you know, really shining a light and on the key needs, on, you know, some of the progress that's been made, which is very very encouraging, but also what the opportunities are looking ahead to Seville and thereafter, and where the business community can lean in and what can be done to accelerate that leaning in. I now want to turn the floor to Dr. Akash Deep to speak to the same prompt. And Dr. Deep, the floor is yours, and thank you for joining us.
Thank you very much, Norine, and greetings to everyone who's on this meeting. I'll describe the space, Norine, and you know we are all familiar with it, but there is a significant realignment in development cooperation that we are witnessing, and it is of course constrained fiscal space. That has always been an issue, but you know we are witnessing shrinking ODA budgets, donor fatigue. I would even say distraction with other priorities such as humanitarian priorities, climate priorities. These are goals that are all competing with development aid. There is growing political and geopolitical risks and the urgency of climate action. And all of this within a space where the aspirations and the demands of development are higher than they have ever been and accelerating at a pace that is hard to keep up with. The thing to keep in mind is that these are not temporary disruptions. They are structural shifts, and they do demand a new playbook in the infrastructure investment space. So we don't just need more infrastructure, we need to build the right infrastructure, we need to build the more socially impactful infrastructure, we need to build the most climate resilient infrastructure, and we need to bring that infrastructure by rallying the energy and the efforts and the resources of more than just the traditional ODA channels that have been there, right? And that's where the role of sort of the private sector comes in. And it's important to keep that in mind. It's not just as a source of capital, but a source of innovation and execution capability. We want the goals of the private sector to be not just overlapping, but actually adjacent and complementary to the development goals that we have pursued. And that bringing in those broader objectives is important and will come into the playbook only when we engage a larger set of stakeholders, including the private sector. So you asked me, Norine, what are the changes that we should be cognizant of? And I'll mention 3 here. One is the shift from this donor-recipient model to sort of a co-investment, co-creation model, right? We are seeing the start of that through blended finance, risk-sharing type structures, where the private sector is not just an arm's-length financier, it is actually a partner and a co-developer and a co-owner of the solutions, right? And the next major change that we are seeing is the shift from grants to leveraging those to bring in more private participation. Guarantees, de-risking, credit enhancement, blended finance, all of those pieces. And finally, in the area that we've been working on is this conflation of climate and development. Development is, as I said, accelerating and at a fast pace in a large part of the world. And climate impact is sort of an inevitable part of that. And the two come together, the two are entangled in the sense that we are channeling and seeking to achieve climate priorities through the traditional development pipelines. And this blurring of objectives is leading us potentially to some crowding out, potentially to reaching suboptimal goals on both counts. And so this is where the role of the private sector in infrastructure comes in. Where should infrastructure go? Definitely, as Dr. Santos-Paulino pointed out, physical infrastructure remains important. Power generation is a very large part of thing, as we have seen through the research that UNCTAD has done. Urban mobility, transport, water, sanitation, these areas are critical for development, but they're also critical for decarbonization. But financing them requires a structural innovation. But the climate premium remains a barrier, right? There are many climate positive projects, but they are not financially viable. More importantly, and Norine, you use the term sort of people-centric, right? The word that we have used in our research is development optimal, right? But they go towards the same idea. And it is not always the case that the climate optimal project is also the development optimal project. And therefore, there is work that is needed to recognize these benefits explicitly. Right. And the result will be, as Amadou Rae was pointing out, we are talking about access and resilience from again, not just a political and a climate perspective, but from an empowering perspective in terms of the workforce, the future market, and health systems, education systems, skill systems that we have to develop. So if I may take one more minute and just tell you very quickly about the proposal that we are working on in terms of private participation. It's a very simple idea. It's about trying to disentangle climate impact from development impact, to be able to bring in local or development finance for the development optimal solution, but then to make sure that they are green solutions, they are climate friendly solutions by bringing in incremental financing and the skills of the private sector. And the risks are allocated accordingly. Local, political, regulatory risks are kept in the development space, and climate risk is transmitted to global private investors. And what the private investors bring in here is not only their expertise, but access to lower cost capital, right? So the key to unlocking private capital is reducing perceived risk. And what we are saying is that this is through disentangling and then partnership. And that's how we make, green projects viable, but also developmentally fair and just. So just in closing, I'll say that if F54 has to be a turning point, we need practical, scalable solutions. The one that we talk about is what we call the green swap. But we need to unlock private finance without distorting development priorities. That's the important constraint there. And we need to build that bridge. The next wave of public-private collaboration, Norine, I think, will be driven by these aligned goals of mobilizing complementary resources. So F54 shouldn't just recalibrate financial flows, but it should really reimagine the way in which we do partnerships. Thank you.
Thank you, Dr. Deep. And I really love the image of disentangling, because as anybody who looks at, for example, the draft outcome document of the Finance for Development conference, there's a lot of disentangling needed and much more synergy, as you described so very well, and the opportunities of partnership and bringing in the private sector in a more continuous and substantive way is we think key to that disentangling and even pursuit of synergy. So now we turn to our last expert, Dr. Mamiko Yokoi-Arai, who leads OECD's work on financial market policy issues and is responsible for developing policy in relation to infrastructure and alternative financing. She is the head of the infrastructure unit at the OECD Investment Division, and she's going to talk to us about some of the realities that we all know, which is not all investments are created equal and not all infrastructure is the same. So Dr. Yokoi-Arai, how do you see global investors being able to push for greater human rights, environmental, and sustainability to be addressed from the demand side for greater sustainable quality infrastructure investment? And on the other hand, what measures can emerging markets take to improve their enabling environments and improve investment into that quality infrastructure? So I want to turn the floor over to you. Thank you again for joining us, and we so appreciate the work of the OECD in this space. It continues to break a path that is very interesting, and we see real opportunities for progress with the private sector. So over to you.
Great. Thanks very much, Norine, for that introduction. So I'll be speaking primarily from a financial market and investment perspective. I'm not really involved in the development space per se, but as a result of doing a lot of work for the G20, we are sort of familiar, and we are actually developing a report on blended finance for infrastructure this year. So I just want to sort of hark back to some of the basic statistics or data points that we know. It is thought that $3 trillion is necessary by 2030 to achieve the SDGs in the Paris Agreement for infrastructure investment. So that is a huge number. And in no way is ODA or the domestic budget, physical budgets, are going to be able to plug that in. And this is why the private sector involvement has become critical to be able to achieve these. And the problem is that, as you can imagine, the way that the enabling environments in each country are does not always cater for this. So I just wanted to sort of highlight that. Maybe also going back to the diagram that Amelia presented about the countries, in terms of the number of project investments that are being made. Asia sort of shines a light in how it can be done. And I think India in particular is very promising because they don't only have project financing, they have a lot of global institutional investors that are present and investing a lot in equity investments. Also, I think the buzzword nowadays, and I suspect it will be in civil as well, will be blended finance. Blended finance has become a really big way. And I think what Dr. Deep was also talking about essentially goes back to blended finance approaches, but how to really leverage public sources, MDBs, bilateral finance sources, to be able to bring in private sector capital mobilization. Our Development Assistance Committee has a couple of data points on this. It is in one of the things that we know, and I'm not going to present the diagram, but it is a bit readily available on the OECD website, is that guarantees are in particular an effective way to actually mobilize private sector. And I'll talk a little bit about that as I go along. So maybe starting from the environmental human rights aspect, a lot of the emerging and developing countries thinks that achieving these are a cost. The issue is that they're actually a really effective way to address the costs, because investors need to be able to know that the potential liabilities that arise from projects are sort of already considered. And for that purposes, most asset managers and institutional investors will have certain sustainable finance goals, and they will actually carry out due diligence, which will go over these. So therefore, you may think that some emerging countries will tell you, well, that's a cost, so it's too much to achieve. But in fact, at the end of the day, if you are trying to attract private sector capital, you will need to be able to achieve a number of goals. They may not be as challenging as the EU taxonomy, but there will be certain standards. I think the IFC's performance standards is a really great sort of bar to try to achieve in terms of environmental and human rights areas that can be achieved. And so they should not really think of it necessarily a cost, but a way to be able to attract more global investment into the countries. Some of these requirements may need to be eased in light of some of the changes of the US administration that we know, but we know that a level of due diligence is necessary and will be made in any investment opportunity. And so that's, I think, one of the things I just wanted to first put forward. And then in terms of the enabling environment, I think one of the key things that when we talk with countries, emerging countries, is that they think of their legal and regulatory framework, but they don't really think sufficiently about their macroeconomic environment. Because one of the biggest barriers or one of the risk areas is actually the foreign exchange. If their foreign exchange is volatile, it will create a huge uncertainty about the foreign exchange risk. So being able to have a level of stability and predictability about their macroeconomic environment, it's not limited to foreign exchange, but I just give that as a very specific example, is critical. And so this is one of the base levels that, we really encourage countries to try to have a level of predictability, certainty, and transparency. And for that, you obviously need a governance, a structure that allows you to do this. It's not going to be always available in most countries, but they need to sort of strive for this to be able to really address their enabling, because then the enabling environment will somewhat follow that. I think Dr. Deep already mentioned, or maybe it was Amelia, I can't remember, about the pipeline of bankable infrastructure projects. This is a critical thing because investors are not just looking for projects, they're looking for scale, which means that they need a lot of projects, which a lot of high value to be able to make a decision. I already talked about the due diligence, but if they are going to enter a market, there is a necessary initial cost, initial investment that they need to make to be able to enter the market, because investors by nature have a local bias. They will prefer the markets that they know well. So for them to be able to enter, for example, the African market, there needs to be a level of information availability, data points that are available, which we know are very lacking in this space, to be able to make that decision. So for countries, this means having a long-term priority and strategy that they are going to plan the developments of their projects and their upgrades as well. And I think Dr. Deep, he put it very well in terms of ensuring that there's climate resiliencies in their infrastructures. So that's an important part of building up a pipeline. The MDBs, many of the MDBs and a lot of the other bilateral development partners also now have project preparation facilities. These are great ways to be able to bring it up to the viability stage and have a level of visibility on the types of projects that they can pursue and what cost levels are going to be involved. And obviously, we also need to know what are the financings that are going to be expected, what are the cost elements. We won't necessarily expect all the sort of capital expenditure, operational expenditure information to be available, but we would expect some of the public budget allocation information to be available. And that will be a critical part. It was also mentioned that the institutional capacity is an issue. This is a major issue because in many cases, there's a coordination issue, both horizontally and vertically, meaning between the different local governments and the national government, there's not always coordination. They have different sustainability standards. That's always a problem. The land acquisition is always not straightforward. Also, you have to go to many agencies to get your permits. These are all issues which better coordination and administrative capacity can address. And all the countries, when you speak to the developing and emerging markets, they will always tell you we want more technical assistance because we want more capacity in our government. So that's something that they recognize as well. I'll just talk a little bit about some of the financial instruments. So one of the instruments I want to particularly talk about are green social and sustainability bonds. These are very popular instruments in the capital market, and they are very popular because the International Capital Market Association and the Climate Bond Initiative have prepared very similar but very high standard guidance on how to do the issuance. This means that even if they're issued by the emerging markets, they are providing a level of standardization in the bond issuance. And so many utility companies, in fact, in emerging markets have also been able to issue this because there is usually what we call a sovereign credit ceiling, but as a result of the credit enhancements, they have been able to pierce this in some instances. It is a little bit expensive, but sometimes because of the generation of the proceeds from the bond issuance, this has also been possible. So this has been a very attractive instrument in many emerging markets, maybe not necessarily developing countries, but emerging markets in particular. So, and then the other instrument that has been used are really infrastructure mandated banks because they are able to have a level of earmarked capital that they can provide, and then they can encourage the private sector mobilization to take place. And then I just want to mention briefly the guarantees. Guarantees have been about 17% of the private sector capital mobilization instruments that have been used, and they have been very effective in terms of bringing in the banks and the project finance that Amelia mentioned to come in. And these are very useful because one of the problems that we see is that I think Dr. Dadeep mentioned sort of the fatigue around the ODA is that sometimes you go to countries and they are highly dependent and expect a level of ODA to come in. So their efforts to actually bring in the private sector are sometimes limited. And we have experienced this in discussions with the policymakers. But bringing in private sector capital actually sort of incentivizes the countries to do a more efficient management of their projects. So we think things like guarantees and blended finance approaches could be a really critical way to mobilize the private capital to developing country infrastructure. Maybe just one last thing I will just add. In some of the discussions we've had in the G20 in particular, there's now started to be a little bit of hesitation towards energy investment. And I think it's because the energy investments have a clear revenue stream. So therefore, even without the public sector assistance, energy investments are usually able to take part. There has now been a more emphasis around, I think, the social infrastructure, Norine, that you mentioned, as well as some of the water management to address climate change resilience in particular. So we have seen a little bit of a shift in the emphasis in the infrastructure sectors that countries are now targeting. So I just wanted to highlight that as well. I'll stop there. Thank you very much.
Well, thank you. Thank you for that great presentation, and really appreciate the, the reminder that we have many functioning tools already at our disposal. I mean, the toolbox is full of options for finance. And, my takeaway from our three experts really is that on the one hand, we're in a situation of change and structural transformation. I think Dr. Deep particularly emphasized that. But at the same time, the basics matter. The fundamentals don't change. And partnerships with the private sector and other stakeholders is a way to build the bridge between those realities, innovation on the one hand, and on the other hand, needing to get the enabling frameworks right. Well, we're now going to turn to the second half of our program and hear from business. And we have three outstanding thought leaders and practitioners who are right in the middle of this issue. And I'm going to start with Sandra Hanni, who is a global policy lead for trade and climate at the International Chamber of Commerce, but also really carrying the flag for ICC in many ways with respect to its leadership in the FFD4 Private Sector Advisory Group, ICC Secretary General John Tenton. Sandra, there is an extremely wide range of opportunities for FFD4 outcomes to engage and leverage business around the world, and ICC, of course, representing quite a broad array in the Global South and the Global North. Could you talk about ICC's priorities for FFD4 outcomes with respect to infrastructure investment and how ICC sees some of those outcomes delivering for small and medium-sized companies and communities, business communities in the Global South? And thank you so much for joining us, and thank you for all the hard work you do in this area. So Sandra, over to you.
Thanks so much, Norine, and thanks also to USCIB and the Foundation for inviting us, and really pleased to be with you today and share a bit of our perspectives, in particular also coming from our long historic involvement in the UN process, in the financing process for development. So really, ICC really we led the private sector engagement for the from Doha to Monterey to Addis, and now co-leading also with the Global Investors Alliance for this conference in Seville, but also wanted to also highlight the very important roles we have as the only permanent observer in the private sector observer in the UN General Assembly, and also a very important leading voice in the UN climate change process, as well as to the WTO. And just highlighting this because I think these roles give us a really important mandate, and we see that this mandate only becomes now more important given the current challenges we are facing, and really see that really being a bridge between governments, businesses, and private sector is really what we would like to strengthen and build on, and we really see a lot of potential to bring the business expertise from a network such as the ICC to this important forthcoming discussion. So I won't spend too much time in the context, but just a few words on how we are approaching this summit and this 454 conference. So I think, of course, we are fully cognizant of the difficult geopolitical economic challenges, in particular also, you know, in terms of the financing gap that exists with regards to the development goals, also with regards to climate. I think we have seen some good outcomes on the climate side coming out of the COP. But I think also a lot of calls in terms of mobilization of private sector. But I think it's really important to stress that we still lack a full clarity on how this private sector capital can be mobilized more effectively, particularly, you know, on the COP side, but also, you know, I think in particular also in the FFD4 discussions, this is becoming very, very, very clear. So I think this is really an area where we would like to bring more attention, and I think there overall we are seeing very good elements in the first zero draft. I think there are very important elements in particular in the private sector section. I think there are also across the different others with regards to the trade, the domestic resource mobilization, the data innovation. I think they're all important elements, but again, I think we really want to see more clarity, in particular on a clear agenda, clear actions to mobilize private sector. And for this, I think we were very strong from the beginning. We need to really look at the root causes, what's really hindering the private sector mobilization. And I think there is a kind of a common misconception that the private capital is just readily available, that it's just waiting to be deployed without really the necessary groundwork. And I think this is really where we would like UN member states now to focus on. And we particularly see three areas in this, and this has already been outlined a little bit by the previous speaker. So I think there is a lot that national governments can do in really setting the right domestic enabling environments, in really setting the robust, coherent policy systems. I think also with regards to this also talks to climate, but also of course in important development projects, important sustainable infrastructure projects. So I think everything that the national governments can do in terms of providing clear targets, and also setting clear investment protection laws. I think we also see sound permitting regulatory processes for infrastructure projects, strong offtake market for energy investments, and also appropriate fiscal incentives. I think these are all elements that we would like domestic national governments to focus on. I think there is a lot that also can be done in terms of also using the NDCs, the national climate plans, using national development plans in terms of giving these clear signals to investors. We feel that there are some good elements in the current text. I think we would like to see a bit more integrated approach to really bring in the development, climate, and nature nexus together. I think we see there is a really an opportunity to have a more efficient resource allocation, also maximize the synergies around that. I think that that can be really an area where more focus can be given. Then the second one, and I think this was already mentioned before, is really on the role of MDBs. Also in terms of blended finance, I think there's lots of great efforts, initiatives out there. But I think from an ICC perspective, we really would like them to become more of catalysts for private capital. I think there really needs to be a shift on the MDB investment approaches, also a shift in risk taking. So we are providing some elements into that, how they can really be more of a catalyst for private sector investment. And then a final area, which is it's really a complex area and a difficult one, but that we really would like to focus on for Seville, and then also then for the COP, for the climate COP in Belém, is really around financial regulation, macroprudential regulation, where we are seeing that rules such as Basel III that have been really developed after the financial crisis, they seem to be act as a really a barrier in certain specific instances where private capital can be where there's a potential to deploy private capital for emerging developing markets. There is really a need to understand the problems a bit better. So we are currently also working with a few researchers on understanding the issues, the barriers, also the scale of the problem, and then potentially also highlighting a few potential solution or adjustments to those rules. And one is really, I think we are really see an opportunity around critical infrastructure projects, where potentially there could be mechanisms where for enhanced capital treatment that could be explored. Also, how potentially multilateral guarantees could be better reflected in those capital relief requirements. So there are a few different areas we are currently exploring, also with regards to the SME financing. So we are that's really an important part. I think we are overseeing very good reactions to our inputs from different member states. So I think I've just heard there's quite good discussion around this issue currently in the line-by-line negotiations. And we continue providing input in that front. And maybe then just finally as well on of course the importance of the role of SMEs and also trade in general. I think this is very close to ICC. And I think we really strongly believe that we won't achieve our development sustainability goals without really a strengthened multilateral trading system. I think business really needs, we need this predictability, we need certainty. We also need a fair and harmonized environment to really deliver the goods, the services, the innovation solutions for really a sustainable future. And in particular on the SME side, we have just received recent data again that indicates really severe financing gap for SMEs in really across the developing world. So I think this is really an important area where we also would like to see strengthened language in the FFD4 outcome text. So I think there's already some good elements in there, but I think we are providing more inputs into the different solutions that can be tested. I think there's lots in terms of improved credit risk tools, lower the cost, as well as digital solutions. So I think that's on the trade, and maybe just really a final word also on the partnerships. I think, despite the challenges we are seeing, I think also, seeing in with regards to the PrepCom, I think there is a real opportunity as well in not only addressing the systemic risks such as just outlined, but also in thinking about these new partnerships and new models of collaboration that we could really establish, really building on the traditional channels such as our role in the UN and different other UN bodies. So I think that's an area really where we also would like to provide more input and happy to come back on that. But
we are doing some thinking around that, so that the private sector can not only be a contributor, but also really a partner, as mentioned before. We'll stop here. Thank you, Norine.
Thank you, Sandra. And it's always impressive. And I think in this issue in particular, to hear the 360-degree perspective and involvement of ICC, clearly this is so deeply embedded in terms of numerous both policy, market, and finance dimensions that that's the only way to proceed. And so it's fantastic that ICC is carrying this important role for the private sector. I'm going to turn now to our next speaker, Tam Nguyen, who is president of Bechtel.org Impact Company and is a member of USCIB's board. At various moments has been the founding parent of our SDG work, and then more recently a leader of our corporate responsibility effort. Tam, at the risk of stating the obvious, Bechtel is known for its projects all over the world relating to the built environment, but also for its unwavering dedication to advancing sustainability. Could you comment on how the company ensures its projects are people-centered and how, that goes into the design, measurement, and tracking of those attributes? Any examples that you could share would also be very interesting. And thanks again for your support of USCIB and for joining our webinar. Over to you.
Yeah, thanks, Norine. It's a pleasure to meet all of you. So I think to kind of build on what Norine just said, maybe I give 30 seconds of Bechtel.org, because that's exactly what we were trying to create to focus on social infrastructure and measurement. So as Norine said, Bechtel is the commercial arm of our project delivery and infrastructure. When I was the chief sustainability officer at Bechtel Corporate, I was involved in creating Bechtel.org, which is our impact infrastructure arm. And what differentiates Bechtel.org from Bechtel is that we're a break-even business, but we measure our impact. We've always been, and we don't have all the answers, but we've always been wanting to know what is the correlation between our infrastructure and the social impact. And that's what really differentiates us. The three things that we do based on, 2 or 3 years of, working in the market, particularly, we'll call it the social impact market. It's project delivery, accelerating the upskilling and growth of local firms and a workforce, and asset management. So we are involved in EPC projects, engineering, procurement, construction across a range of sectors. And I'm talking about Bechtel.org, which I run. Some of those are health facility electrification, canal restoration using nature-based solutions, food security, climate resilience. We originate our own projects so that we can kind of shape and influence the kind of impact that we want in the project. We also prioritize financial sustainability, especially for the long-term operations and maintenance. And that's something that we see that creates a lot of failures in social infrastructure projects. Nobody's operating and maintaining the assets. And for us, if nobody's operating and maintaining them, we put the entire social impact at risk. I would say over the last 2 years, while we've been working a lot with working in partnership with all sorts of organizations, including UN agencies and public aid agencies, we have started pivoting much more towards the private sector. And there's a few reasons for that. And we are working either directly with them or through blended models, which some of the prior speakers were talking about. Currently, we're much more focused on partnering with project developers and private investors who bring finance. There are commercial finance, but also they're innovative as well. I think the entire industry has just gotten smarter and better about this. They are focused like us. They really want to build an ecosystem of capable local firms. And that's one of our key focus areas as well. And there's 2 reasons for this shift. It's not just the shift for money. It's the shift is because we see working with them, the scalability of the projects is larger, but also the transactional process is faster. It's a bit more simplified. And they see us, Bechtel, as helping to de-risk their investments, where many times the public aid agencies did not see us that way. And that's important because we have lots of capabilities to help de-risk their investments in infrastructure. And we have a lot of tools that can be deployed in right size, but it wasn't always seen by the public sector as a value proposition. So I'll give two examples, and I'll be quick. One is in climate resilient infrastructure. So we're engaged with investment firms and banks to create an emerging market private equity fund and a technical accelerator. We're the technical accelerator. The aim is to help grow mid-growth EPC, engineering, procurement, construction suppliers and subcontractors. So these are not the big infrastructure companies, but these are the ones that are working with them to supply products and service like underwater and marine construction, building information modeling, geotextiles, and synthetics for flood defense projects. These are key suppliers and subcontractors for any climate resilient infrastructure project. And so part of helping them grow is to also enable them to participate, again, in large infrastructure, large flood defense or extreme heat projects. And the impact is that we're supporting the growth of a marketplace of suppliers and subcontractors for this kind of infrastructure, which is frankly underdeveloped in these markets. If we spent nearly 2 years with investment advisory firms and others that share common cause with us to really study this, meet with the governments, meet with the private sector, meet with the investors, meet with sovereign wealth funds. So we have it's a nice blend of what Bechtel does well in infrastructure and what the investment community is looking for in terms of risk and opportunity. The second and last example is a health facility electrification in Africa. And we created this project with USCIB and other partners to solarize 10,000 health facilities across Africa. But, even before the closure of USCIB, we also started to engage much more with the private sector, more directly. And the major reason there was financial. The biggest risk that we started to see was the financial sustainability of maintaining the power system and the asset. And that was frankly the biggest challenge. The installation was easy. We can install very rapidly across, but who's actually going to own and operate this? And so we partnered with a South African project developer who brings the financing, but more importantly, they have a business model with health ministries that is, for us, very effective. The biggest, for example, just to give you a very quick context, what we discovered is that the biggest cost for the health ministries is actually power. And with the developers' approach and methodology and business model, by switching to solar, the savings is extremely significant. And so significant, we saw the real impact. And the real impact is that savings now goes to the health ministry to do more products and services, expanding healthcare. For us, that was a tremendous impact. That really drew us both from a commercial standpoint and an impact standpoint to start working with them. And now it's actually crowding in, because of that business model and because Bechtel is involved in de-risking, Bechtel.org, it's crowding in other investors now. We were in London, we were in other parts in London, Luxembourg, and some other capitals, and they like this model and this approach that we're putting together. And so what are we doing? We provide capacity building I'm talking about Bechtel.org's role in this. We provide the capacity building for thousands of local installers. And again, our focus on building the ecosystem for this project, but other projects as well, other solar projects that might be happening in the region or in the country. Most importantly, for the project developer, we oversee the quality control of the installation, especially as these assets will be maintained by them for 15, 20 years before they're handed over to the ministry. So again, for us, if we don't focus on the asset management piece of this, we feel like the whole social impact is put at risk, which is the access to the healthcare. So over to you, back to you, Norine.
Thank you, Tam, for those inspiring examples. And it really then leads us very well to our last business speaker, Amadou Sako, who's an advisor and project officer for Africa at the International Organization of Employers. Amadou, I think it's fair to say that IOE is where the rubber meets the road in terms of involvement in people-centered infrastructure. in terms of employers, in terms of workers, in terms of community and society as a whole. And IOE has really been a catalyst to inform this conversation and to find ways to guide employers when it comes to the investments of money, time, and expertise wherever they operate, and particularly in the Global South. So could you share a couple of examples, and I know there are many, of recent IOE projects or work streams that do pertain to building skills and capabilities relevant to the SDGs? And thanks for joining us, Amadou, and your hard work is really stellar, and we appreciate it. Over to you.
Thank you very much, Norine. Thank you. It's always a pleasure. And good morning and good afternoon to all of you. I'm very pleased to join this panel on behalf of IOE. So to start, I really want to stress a core principle. People are the first infrastructure. So physical assets, ports, road, digital grids are vital, but their value depend entirely on the people. We can use, manage, and innovate without the people. Yet we also know that even the most promising project can falter without the right conditions. Finance is part of the picture, but as the 2024 Financing for Sustainable Development report rightly notes, deeper structural issues in the global system may also be addressed if we want sustainable change. And let me begin with the basic. Employability, entrepreneurship, and upskilling are powerful development accelerators. So here I'm talking about skills. Skills are not a side issue, they are the foundation. Without them, public investment fail to generate economic inclusion, digital transformation can widen inequality, and infrastructure risk becoming underused or unsustainable, as we see it, unfortunately, around the world. Unfortunately, many education and training systems remain disconnected from labor market needs. And IOE's research with BIAC confirmed this mismatch is systemic, often reflecting outdated curricula and limited responsiveness to private sector demands. So to close this gap, we must see human capital as an infrastructure, as the first infrastructure, and finance it accordingly. But we must also improve the policy and institutional environment that supports it. In too many contexts, regulatory system, tax incentive, and social protection are not aligned with skills development and sustainable entrepreneurship. So at the IOE, we really try to focus on solutions with our members, and one of them is the Tech at Work project, an initiative with Microsoft. So we've trained about 20,000 young people in 5 African countries: Senegal, Uganda, Republic Democratic of Congo, Cote d'Ivoire, and Lesotho. So in digital skills and human and social skills to foster their job readiness. And we rolled out a digital platform for mentoring and job matching also. We provided to our graduate financial education in partnership with a Pan-African bank. And we've also started a partnership with the with ENABEL, the Belgian Development Agency, which is called the Work Readiness Program, in order to foster the integration of young people within the job, within the work environment. So these are not isolated efforts. They really show that when they show what works when skills, finance, and opportunity are connected, and when business is involved from the start. But scale remains, of course, a challenge. And again, as the latest Financing for Sustainable Development report highlights, the global system still struggle to mobilize investment in fragile and informal setting, not only due to financing gap, but because many environments are simply not enabling or unclear. Hence, risk are mispriced and institutions are under strain. The key issue here is informality, a policy area on which the IOE and I personally work a lot. In many countries, more than 70% of employment is in the informal economy. Informal workers and enterprises, they face barriers in accessing capital, social protection and services, and also skills development, and are often excluded from public investment and support systems. Of course, this limits their growth, It limits the growth of economic units and keeps them outside the formal regulatory framework. Which brings me to the second piece here, skills plus finance. The second piece is finance. Skills plus finance equal sustainable business practice and sustainable development. No matter how strong the skills, or if businesses lack access to credit, capital, and digital tools, among other, their potential remain unrealized. And this is especially critical in informal economies where financial exclusion is common and formality is often a barrier to accessing these resources. So formality isn't just about compliance, it's really about to create a foundation for businesses and people to apply and expand their skills to develop. When businesses transition from informal to informal, they not only unlock access to finance, but also gain opportunity to implement sustainable business practice. And again, this is why IOE, in collaboration with UNCTAD, will co-host a side event during the upcoming FFD4 in Sevilla, Spain, under the theme Financial Inclusion for Business Development, Bridging the Formal and Informal Divide, where we will explore solutions to improve access to finance, support digital financial service, and promote policy reform that help businesses transition from informal to the informal sector. Talking about skills, looking ahead, it's important to mention that the topic of artificial intelligence, which is already shaping how we live and work. And at the IOE, we see AI as a powerful enabler, but one that reinforces the need for human skills also, such as creativity, critical thinking, emotional intelligence. And recently, we released a report on reshaping human and social skills in the digital era, outlining how to embed this competency in both education and workplace training. And maybe I will end with a call of action and a few recommendations. So let me close with 3 key messages for the upcoming, for this panel today, but also for the upcoming FFD4 in Sevilla. First of all, we need to invest in people. We already know it, but we really need to put skills and employability at the center when it comes to development. Human capital must be treated as a foundational investment, not a secondary priority. Second, we need to build connected system. We need integrated approaches, linking skills, finance, policy, private sector engagement, not fragmented project. And finally, we need to create enabling environment to support entrepreneurship and innovation by improving access to finance, reducing regulatory burdens, and aligning incentive with inclusive, sustainable outcome, especially for youth and women. And by prioritizing human capital, building integrated system, and supporting inclusive business practice, we are creating the condition that lead to de-risking investment, a point that has been rightly emphasized earlier by 2 of our speakers. So reducing regulatory barriers, ensuring access to finance, I cannot repeat it enough, and aligning incentive will directly lower the risk that typically deter private sector involvement, development, and decent work and living conditions. Thank you.
Thank you, Amadou, and thank you to all our speakers. What a very rich and thoughtful set of suggestions and calls to action you have provided us with. Our conversation will be continuing in Geneva in early May, and we'll be getting more deeply into some of this subject matter, as you can see on this slide, and we'll be headed to Seville. But to bring us to a close, I want to introduce the President and CEO of USCIB and of the USCIB Foundation, Whitney Baird. And Whitney, the floor is yours for concluding remarks, and thank you for joining us.
Yes, thank you. Thank you, Norine. Thank you for all the work you have done putting this program together and the Business Pact for the Future project. You know, I would say U.S. business has had a long record of positive engagement and partnership in development through international organizations and vis-a-vis national development agencies. But we're currently in a situation, certainly, where that landscape in the U.S. is changing under the Trump administration, and as Tam noted, the closure of USAID. But the need does not go away. And USCIB itself has been an engaged partner in the Monterey Financing for Development process since 2005. bringing U.S. business views and hands-on involvement, particularly through the ICC, which has been a central convener for these key UN meetings as they have expanded in scope and ambition. We're looking forward to joining ICC and international business in Sevilla for the intergovernmental meetings and to contribute to the International Business Forum. Actually had the opportunity last night to sit by at a dinner by one of the sponsors of the International Business Forum, and they're getting actually good uptake, and particularly on speakers. So hoping that this will be a really dynamic event. As we've heard from the experts this morning, the significant shifts we are experiencing in the development landscape create some new opportunities and expanded roles for the private sector. And against the backdrop of these changes for USCIB, the investment framework fundamentals take on an even bigger importance for the pursuit of new approaches to partnering with business on infrastructure in all its forms. We're looking to the final talks in New York next week to try to frame the FFD4 outcomes to really emphasize these basic necessities to mobilize private sector. From a business standpoint, companies are planning and executing their investments and collaborations in the infrastructure arena with more attention to impacts and benefits for people. Really appreciated hearing from Tam very directly on that. In addition to the built dimensions of infrastructure, the private sector is engineering and other elements of capacity building, whether on education or skills, and through digital technology options, which are a new and catalytic development since the last FFD conference in Addis. We want to recognize and thank the funders and supporters of the Business Pact for the Future, our global sister organizations, IOE and BIAC, of course, as well as ICC, and the hard work and support from UNDESA and the FFD4 team. I want to commend the OECD in driving the Blue Dot Network as a framework that shows the potential to certify development projects or infrastructure projects to agreed standards, including for societal, community, and worker impact. We believe successful BDN, it's just one of the ways that project sponsors can, I hope, reduce some of the due diligence cost and the time lag between coming up with a project and actually getting before funders, whether it's official development, whether it's regional development banks, or the private sector. I'd like to thank all of our speakers today and those in the audience who have joined this webinar. You know, one of the things I think Tam really brought up, and this is just an area I think we can never emphasize enough, which it isn't just the initial costs in building or performing a project. We really have to look at the life cycle costs. What does maintenance and upkeep and long-term staffing mean? And so it's that's an area I think where the private sector can be quite a useful partner, because that is the way the private sector looks at projects of all sort. Any kind of investment is really not just the initial investment, but what are the real costs across the lifetime of a project. And look, I hope we look forward to seeing many of you in Sevilla, and thank you again. Appreciate it.
With that, we can bring this webinar to a conclusion. Thanks again to all our speakers. Thanks to our audience. Thanks to USCIB Foundation's Human Infrastructure, also known as GenFocon, and we do look forward to continuing this discussion with all of you. Please don't hesitate to reach out to us, and stay tuned in, and we hope that as we head to Sevilla and beyond, we can contribute to progress and new pathways for impact through the USCIB Foundation, working with all of you. Thanks again, and wishing you a great day. Bye-bye now.